Good morning, friends. Today in this session, BOS for your success. I CA Ashish Gupta and CA Chirag Uppal welcomes you for this session on the paper Strategic Financial Management. That is the paper number 2 at CA final level. Friends, this paper is very important for your success in exam because it is a very scoring paper, and since it is a numerical based paper, so student normally enjoys to attempt this paper. Further, this paper also has very practical application in your practice as well as in your, you can say, day-to-day life also. But moreover, when you will go into the industry, you will find that this paper is very helpful. So, student, in this session, first of all, we shall start with our overview of the syllabus. That I will discuss what are the major topics are covered in the syllabus and how what is expected from you. You are free to send your query at the link provided to you. We shall try to attempt all the answer your query during the session. So friends, let us start. First of all, I come to the first topic of the syllabus, that is overview of the syllabus. Now friends, whenever you go for any paper, very important that you should first understand what is the objective, or we can say what is the main why we are taking this paper. So objective of the syllabus is very important. Now the as it mentioned that to apply, to acquire the, one second, to acquire the ability to apply the financial management theories and techniques in strategic decision making. So that's why this paper name is Strategic Financial Management. Because this topic you have studied at your inter level, there you have discussed the various basics of the financial management. Now here, their application in your strategic management decision will be covered here. Once we we will move on to the referring the syllabus, then we shall see that how we shall see that how what why each topic is near to our strategic management decision. So let us start first with the first topic, financial policy and corporate strategy. Now here the two topics are important. Three topics are we having: strategic decision making framework, interface of financial policy and strategic management. Because whenever there is any business, the strategic management is one of the their pillar. It is the strategic decision that makes one business a successful tycoon, and another wrong decision, strategic decision, can lead to into the bankruptcy. And that's why if when we proceed further, you will see that there is one topic, that is merger and acquisition. So that is the reason that merger acquisition is a very strategic kind of a decision, and that has been covered here also. More important here, student, that please note that we have to discuss the financial aspect only. Of course, when we talk about the merger acquisition, there may be various decisions that involves like legal decisions, taxation point of view. But our objective here in this paper is basically to concentrate ourselves onto the financial aspect only. Then we come to the next topic, financial goals versus sustainable growth rate. Sustainable growth rate nowadays has become very important. Okay, whatever the growth we are maintaining, it is very important that we should be able to maintain the same. Because a higher growth, say in a one time you go like this, and another year you just fall down. It is not like that. It is not a good thing. Rather, it will be better if you take a moderate growth, or your growth graph is like that, but still you are maintaining sustainable growth rate. So sustainable growth rate is one of the important aspect. So another like decisions can be like, for example, buyback of the shares is also a strategic decision. Okay, now there is one topic that is recently, I think around 1 or 2 years back, one question has been asked on external funding requirement. Now, students, although this topic is a numerical theoretical topic, but generally numerical questions can also be asked from the this question topic. And in this series, the topic has been question has been asked from the external funding requirement. That is how you have to generate the funds. How you, of course, you can say that, sir, it is covered in our financial management requirement of the finance there, because when we talk about the financial management paper, that there are three decisions are broadly covered. So first of all, you can say investment. Okay, then you are under this you study the capital budgeting. Then another is your financing decision. Here you cover the decision of cost of capital, leverage, and capital structure theories that we have discussed there. And another is your dividend distribution. Of course, there is another aspect is working capital management that has also here covered, but normally it has generally covered in the your financing, or you can say that you can also touch upon this investment capital busting this. But capital busting is generally for the long term. So normally we say that it can be touched upon here. But working capital management is another area this. So, but here, student, of course, you have discussed the cost of capital aspect and financing decision. But here the external funding requirement is kind of a strategic decision. Viewpoint here is strategic because here whenever we discuss this topic, we cover it, from the strategic aspect, like how much we have to maintain the strategic funding ratio, or what will be our debt equity ratio, etc. All these points has to be covered here. So this is though it is a theoretical topic, but numerical questions can be asked from this topic. Now this is the risk management topic. Chirag, just read out what are the main topics covered here.
Yes, sir. The first topic is identification of types of risk faced by an organization. The second topic is evaluation of financial risks. The third topic is value at risk. And the fourth one is evaluation of appropriate method for the identification and management of financial risk.
Yes, thank you, Chirag. Now, student, this topic starts with the types of the risks. Now, importance of the risk has become, you can say, has increased a lot, especially post COVID-19. The term risk management has gained very importance. Earlier, there used to be risk manager. Of course, they are generally, some companies may have employed the risk management because they want to meet some statutory guidelines, regulatory guidelines, etc. But their importance has become multifold because post COVID, the companies have realized that the risk can be of any type, because no one was expecting that there can be any situation where the world will be stand still. And a very interesting fact, it is a COVID-19 when the oil future has become negative. Okay, this has happened in the history first time that the oil future was trading at negative value. Why? Because the problem was that how to store the oil, because the storage cost was that huge, that holding the cost is that much higher, that the future selling is become future has become negative, because no country, there was no movement of any vehicle, so there was no consumption of petrol. So this was a major reason that it has happened that oil future has become negative. So that's why it is called that we should identify the what can be are the various types of risks are faced by the organization. Here there is in this SFM we have touched upon only very cursory. We have given a cursory look because it is not the paper of risk management. There we have a separate paper of the elective paper there, risk management. But just to make you aware that what various kind of a risk a company can face, we have mentioned all the risk. Now next is evaluation. We have covered the financial risk. Now financial risk can be of any type, many type: interest rate risk, foreign exchange risk, currency risk, interest rate risk, and default risk. So these are various types of a financial risk. Of course, every risk ultimately result into the loss of finance, but these financial risks are directly result into the loss of finance. So that's why they are called the financial risk. And in our this syllabus, the major topic that is like foreign exchange risk management, interest rate risk management, derivatives, all these are parts of your financial management of the risk of the management of the financial risk. Now next is value at risk. Now value at risk basically, student, this is a kind of a measure that has evolved somewhere around in 1990s. Okay, I think it was Morgan Chase, not exactly the one investment banker has used this strategy. What they have analyzed, that on the basis of historical data, that they have analyzed that the company normally the loss, you can say the position may be in a norm shape in a normal curve. Okay, loss position. So ultimately you can estimate that if I am in this region, then what is the probability that my loss will be around this much. So you can from this value at risk you can came to know what is the probability that my loss will be this much, and if you are expecting some loss, so you can also came to know what is the probability of the same. Accordingly, there are level of confidence are there like 90%. What is the confidence? I am confident that I am 90% confident my value of the portfolio will not be less than this. I am 95% confident my value of the portfolio will not be less than it. So these all our measures are covered in the value at risk. Next is how we uh, what methods we are used to our hedging our financial risk, that are discussed in a very brief, but in detailed discussion has been covered in the forthcoming chapters. Okay, students. So I hope if any you have any query, you can free to discuss the same. Now this topic is very important. Though this topic is important from the theoretical point of view, forget to discuss one thing. In this, it is theoretical as well as numerical. Both topic can be question can be asked from this topic. Now, this is a security analysis topic. Uh, so there are two top analysis covered are here: fundamental analysis and technical analysis. You want to say something on fundamental analysis? Hmm? Sure. No problem. Now, student, what is the fundament in a fundamental analysis? Basically, what happens? It is called also EIC analysis. Okay, E means economy, I means industry, and C means company. Okay, students. Now let us I just give you a very small example. And normally I always quote that somewhere around in 2007, the concept of BRICS has come into the picture, because BRICS means Brazil, Russia, India, China, and South Africa. So normally these five countries have been identified by the worldwide investors for making the investments. But before making the investment, what they have to do, they have to carry out their analysis. First, they analyze the economy. Now there are many measures are there how to measure the how to you can say how to evaluate an economy. There are various barometers are there that has been covered in study material also. So there they discuss which economy so generally GDP is one of the very good indicator. Now suppose in out of these five countries they select okay India is the best, because they are I think at that time our GDP somewhere around 8 to 9, something around that. So they say okay let's go for India. Now, when they choose the India as their destination of investment, next question comes: in which industry? As I did not to tell you about what is the industry. Industry means group of companies. So there can be n number of industries like cement, automobiles, telecom, steel, and housing, real estate, IT. So there can be n number another industry also. I'm just for the just for the sake of example. I'm just so now they say okay, which industry is having a huge potential of the growth? It can be automobile at that time. It can be IT. They can choose. They can really analyze. Of course, at that time, IT companies were in a boom. So they say okay, let us go for the IT. Now question rises when they go for the IT, since I have told you there are many companies are here. Now they carry out the company analysis. Okay. Now there are n number of companies can be there. At that time, major companies were Infi. At that time, it was used to be called Infosys. Okay. TCS, Wipro. Have you recall any company other than it? If you ever okay, no problem. Okay, these are major companies. Now they will say ki now which in which company we should invest. Okay, so now they will carry out the company analysis, and for company analysis, they can use ratio analysis, etc., fund flow and cash flow analysis, etc. So now they will carry out the company. So this is called EIC analysis. So that is covered in the fundamental analysis. This is a theoretical kind of a thing. Okay, now let's come to the next topic that is called technical analysis. Now, student, there is a technical and fundamental. There is a one major difference. Of course, there are some differences have been given in the study material. But one major difference is that while for fundamental analysis, the horizon is long term. For the technical analysis, the horizon is short term. So, for fundamental analysis, generally the investment are made for the period of 1 year, maybe 3 years, 5 years, like that, or not less than 1 year, at least not. Because they believe in investment for the long time, generally for the 3 years. Whereas on the technical analysis, it is also called chart analysis or chartist, we can say. Here, what happens? They don't go for the long term analysis. They don't go for this whole exercise that which company is performing better, which economics better. What they do, they study the chart pattern, the share of which company is rising, the share of which company is going down. They go by the short. Okay, accordingly, they make buy the share, they sell the shares. So their vision is for the short term because they believe that somewhere they have developed some pattern like this share is moving like that, this. So they say, ki, okay, let us, this is a point where we should purchase this share, and this is a point where we should offload the share so that they can make the gain. So this is all analysis are covered in the technical analysis. Now, student, technical analysis is a very long topic, and there are n number of techniques are there. But however, for the sake of simplicity, we have covered only few techniques have been covered, and that too on the theoretical basis. Of course, there are two or numericals are also there where you are expected to call exponential moving average, and one there is uh, calculation of EMH, that is weak form of EMH. Now I'm just discussing one very important point, EMH, efficient market hypothesis. Okay, student, now there are three form, we can say that weak form, semi-strong, and strong form. Now, weak form generally says that any, because it is the reaction of the market. These EMH forms are dependent on the reaction of the market. So here, what happens? The analysis is made on the fact that how the market behave on the information of the company. Generally, these weak form, they react late and they generally based on the act on the historical information. Say results have come out of the company, and after 5 days you see that there are some changes in the prices of the share. So this is a weak form because market has reacted late. Okay, so this is called weak form. Semi-strong means normally market act immediately on any news. Okay, results have come out and accordingly there is a variation in the market. Now in the strong form, it is also called, you can say that it is in the market react very quickly. Even just before the results are out or any news is out, the market start acting. For example, very good example is the very prime case is a merger and acquisition cases. In case if there is any hint that the company, there is going to be a merger of any two companies, so the market reactive immediately, then it is called strong market. Okay, now in this case what happened, if we see that now say price moving like that or gradually, okay, the information has come out here. Okay, so if it is reacting this after this news, say 4 to 5 days, this is a weak form. Okay, now here if we say that like prices are moving like that, okay, information has come and immediately it has reacted, it is called your semi-strong form. Now another, I just give example. Now prices are moving like that. Before the information here comes out, the market has started behaving. Okay, so this is called strong form. So this EMH is the important part of your technical analysis. How the market. Another, there are theories have been covered. One is the very important, three theories have been covered. One is Dow Jones theory, an elite wave theory. Another is random walk theory. Now this theory is very interesting. What this theory says, is nothing, nothing news works, nothing market behave in a random manner. Okay, the propounder of this theory has very commented on a very funny manner. They compare, or you can say they pair this, or they make the parity of this theory with the drunken man who is standing on the one side of the street. Okay, fully drunk man, and if he has to go to the other corner of the street, then how will he move? He will move in this fashion, one way, this way, this way. He will go straight like this. So they say that like that. It behaves like in a random manner. Market behave in a random manner. So all these aspects have been covered in this topic. You want to supplement, say, Chirag, anything? No? Now, these are the next topic is security valuation. Okay, students, Chirag, just read out topics of this. Yes.
The first topic is theory of valuation. The second topic is return concepts. The third topic is equity risk premium. The fourth topic is required return on equity. The fifth topic is discount rate selection in relation to cash flows. The sixth topic is approaches to valuation of equity shares. The seventh topic is valuation of preference shares. And the last topic is valuation of debentures or bonds.
Thank you. Now, student, basically, this is a numerical topic. Okay, of course, your previous topic is theoretical as well as your numerical. But generally, from this, numericals are mostly asked or questions are on this example. Now, in this security valuation topic, one thing I would like to discuss with you, student, you see here the valuation. One thing I just cover, then I will come. Of course, I will touch upon this cash flow also. First, I will want your attention to these three: valuation of equity share, valuation of preference share, valuation of bonds. Now, I will link these three topics to your intermediate financial management paper. Students, when you were discussing the topic of cost of capital. There are three type of cost of capital. One is cost of equity, that is KE, cost of preference shares, and cost of debenture or bonds. Here, normally we use the term bonds, debentures, of course, are there. So that is called KD. All topics you have discussed at your intermediate level. There, what was happening? There, what was happening? You have been given the price of equity share. Okay, and dividend was there, growth rate was there. You have been asked to calculate what is the cost of capital, that is cost of equity. So the formula was like that, D1 upon my P plus G, if you recall that. Okay, now here in this chapter, what will happen? Here you will be given this figure. This is the expected. This is the expected from a share. D1 figure will be given to you. Okay, 1 second. Here I am my mistake. Okay, this is for inter. You have to call. Here you will be given this. You will be given this. You will be given this, and you have to find this figure. How much price is justified for getting this much of return? Had the dividend figure been this much and the growth rate is this much, so accordingly we modify the formula and we get this value. Okay, students. So formula is same. You see, in the intermediate you are using this formula, and here you are in the final level you are using this formula. That this figure, everything is same. There is only one unknown variable that you need to calculate. Of course, here is also one unknown variable, but the difference is that the the nature of the variable has been changed. So whatever you have discussed, studied at your final intermediate level, now here we will use the same. Okay, students. Now, similarly, like cost of preference shares, and especially it is important in case of your bonds. Okay, so bonds, like similarly, KD is given to you. Okay, now you have to find how much price is justified. Okay, in addition to that, there are one or two things in a bond case we are covering, that is duration of bond. Now, why duration of bond is important? See, sometime it is said that generally we student. Okay, that I will cover, Sumit. Don't worry. Okay. Uh, Now, next is coming duration of the bond. Why duration of the bond is important? Because generally it is said that market is volatile. Shares are volatile. Prices of share are volatile. No, student, please note, the prices of the bonds are also volatile. Prices of the bonds are also volatile. Why they are volatile? Because the discussion has been covered in this topic regarding the prices of the bonds, and because why there is a discussion has been covered here, I'm just sharing with you. 1 second, I get to name. Please note, bonds price and interest, prevailing interest rate has an inverse relationship. Okay, like that. If interest rate are here, either the price of bond here, with the increase of interest, the bond prices will go down. Okay, so that aspect has been covered here also in this paper, in this level. And that's why duration of the bond help us to know the volatility of the bond, that is how much the price of the bond will change consequent upon a 1 point change in the interest rate, 1 basis point. So all that has been covered in this topic. Another aspect of the bond is conversion aspect. That we shall discuss here how the market, because see what happens, convertible bonds are a form where they are converted into the equity share. Now it is its analysis is also very important, because suppose I'm just giving very small example, one share, one debenture is there, trading in market, say at 1050, and it is a convertible debenture. Yeah, you can get it converted into 5 equity share, suppose. Now, if suppose the equity share of the company is trading at 250, then straightway there is an advantage. There is a benefit. There is arbitrage profit. Not arbitrage profit. We can say that you can say some kind of arbitrage. You buy the bond at 1050. Okay, get it converted to 5 equity share. You sell the 5 share at the rate of 250. You get 125. Of course, very straightforward. You can earn the profit of 200. Okay, so the various aspects of convertible bond have been also been discussed in this topic. So all these aspects regarding how we analyze the security from the different angles, that has been covered here. Okay, 1 second. क्या हुआ? Now next comes up portfolio management. Okay, next comes the portfolio management. Just you start discussing the same. Just read one by one.
The first topic in portfolio management is portfolio analysis. The second topic is portfolio selection. The third topic is capital market theory. The fourth topic is portfolio revision. The fifth topic is portfolio evaluation. The sixth topic is asset allocation. The seventh topic is fixed income portfolio. The eighth topic is risk analysis of investment in distressed securities. And the last topic is alternative investment strategies in context of portfolio management.
Thank you. Very, very good, Mayank. One student has pointed out that, sir, is bond refunding is important. Yes, student, it is a very, you have raised a very good question. Refunding of the bond is also important. Now, this topic can also be covered here, like strategic decisions. Okay, so refunding of the bond is also equally important, but normally what happens, refunding of the bond is important, but it is normally a capital budgeting type of aspect is covered here. Here the valuation of bond is not done here, but it is a kind of a capital busting decision, because a company has to take a decision that whether we should, because as you maybe have noticed that when the interest rate, suppose I just give you a small example, a company may have issued the bonds at say 8%. Okay, say 5 year ago. Not 8% is okay. Now say today the rate of interest has come 6%. Now company if have a call option. Okay, call option means they can call the bond for the redemption. Then of course they can say that I will refund this bond. Okay, I will refund this bond at 8% and I will issue the new bonds of the same amount. So there will be of course saving of somewhere around 2%. There will be saving of around 2%. So, but what will happen? There is some transition period. How? Because they cannot refund the bond. First, they refund because they don't have the money. First, what they do, they issue the bonds at 6%, and whatever the funds are coming, they use it to refund the same 8%. So this exercise may take some period of say 3 years, 3 months. So during this period, 3 months, they have to pay both. They have to pay the 8% rate of interest, they have to pay 6%. So this is very important aspect that you have to remember in the exam. Another thing is, okay. One, Narayan, and I am just coming to this aspect. Dirty price and clean price of the bond normally cover in the money market instrument. More or generally, they are covered in the more, and that's why you are right. Here we can security valuation. You are recall me that. Uh, Here, another important aspect is writing off your old any outstanding amount. That is another aspect. So all this kind of a type of a capital busting decision. Now, Narayanan R is saying that, sir, please also say that what is the dirty price and clean price of the bond. See, what a dirty price means, whenever, if you say clean price means of the bond, it is trading at some price. Okay, of course, it is a clean price. Clean price means, so discounted price of the bond, we can say that a clean price. But what happens? There is a interest accrued. I tell you, give example. Say there is a, every bond has a one date of their interest. Okay, every bond has a some day of their interest, that is, it will be, interest will be paid, let's say 31st, you can say 30th June, if say it is payable two times in the in a year. Another is 31st December. Okay, now suppose if I acquire a bond on say 1st April. Now what happens, student? This bond will have a two items. One is market value. Okay, that we will get this market value, that if you can say that what is this market value deserve, say some discounting rate, that is called your clearing price. Okay, plus interest accrued, because this bond will be carrying some interest for the 3 months, that is 1 to 31st March. These 3 months will also interest this bond will be carrying. So this is called your dirty price. Okay, so this is also has been covered in a, or one more thing, student, recall me that in a security valuation, there is money market instruments has also been covered. What is the difference between money market and bond? Money market instruments are the short term instruments. So normally, discounting is that discounting aspect is is not applied that much as it is applied in case of bond valuation. Okay, students. Now, student, we are coming to one important topic, portfolio management. This is theoretical as well as numerical based topic. Here, portfolio, some aspects like CAPM model, one of the very basis of this portfolio management has been covered. Beta and CAPM are basis of the, now the beta is, as you know, that it is a volatility of a market vis-a-vis of a security vis-a-vis to the market. So here we are topics have been covered, how we determine the, now what happens, portfolio means, when we define the portfolio means the uh, how may we can say that it is a combination of the various investment avenues, because it is a famous, how many if say if I invest in my all the money, if my I invest my money in a one in securities, it may possible that the money may, the prices may go down and I may suffer the losses. So what do? I diversify the investment. The fall in the one market may there may be another investment opportunity. Ultimately, it will wipe out the losses, average out the losses. So that is called portfolio. And now when we talk about the portfolio, so we have to cover here portfolio, say like portfolio return. Okay, portfolio risk. Okay, now when we talk about the risk is basically kind two type of things. One is systematic and another is unsystematic. Okay. Of course, Kunjan, I will clear you better how many decimal points to take in the PV calculation if nothing else. Just Chirag note down this query. I will discuss in the last. At up to how many decimal points? Just I will discuss cover in the last before winding up the class. Thank you, student. Thank you, Kunjan. I will cover it. Just before the concluding my class, I will of course discover. Okay, you just get me in mind. Okay.
Yes.
Now here, students, systematic risk and unsystematic risk. One more point, how to excel in the exam. Last I can cover.
Okay.
Systematic risk and unsystematic. Systematic risk, it affects all the investment, whether this or that. It will, because generally say if there is any possibility of war, so of course, except the defense industry, all industry shares may will be fall down. This is kind of a systematic risk. COVID-19 affecting all the industries. Okay, unsystematic risk. Normally, this risk can be you can so offset by another an investment because it is affecting only one industry. So it is very important that so now when we talk about the portfolio risk, of course, portfolio return can be calculated based on your simple average. But when we talk about the portfolio risk, here the one major role plays come to into the picture, the relationship between the securities. And for this relationship, the two concepts come into the picture. One is covariance, another is coefficient of correlation. Okay, student. So then this concept, so this you must have a knowledge of this concept. What is exactly this? So coefficient of correlation means the degree of how much the degree can vary from -1 to +1. -1 means perfectly negative, +1 means perfectly positive, and in between there is 0, independent of each other. So all things have been covered here. Okay. Next is your capital market theory. Here, before capital market, we have discussed the concept of Markowitz theory. Now, what is Markowitz theory? It is a modern portfolio theory. Modern portfolio theory says that we should see, traditional theory also used to say that we should invest in the money because money in seeing the comparing the risk with the return, because there is a very important concept, risk return trade-off. Risk return trade-off means higher the risk, higher the expectation of the return. Of course, this theory starts with the traditional theory of the portfolio management. But here, Markowitz has said that we should select the optimal portfolio. The optimal portfolio has the basis of the modern portfolio. They says that very beautifully. They have explained that. I just again draw the diagram. Now they say that if these 2 points returns are there, okay, this point is, say, you can say that A, this is B. Now they have a same risk level, but these have a higher return. So we should go for the same. Similarly here, okay, and similarly we can say that they have a same return but lesser risk. This point. So this forms the efficient frontier. This combination forms a efficient frontier. Now I'm just again redrawing here. When an efficient frontier is drawn is here, a tangent line is drawn, and this becomes the efficient portfolio. Okay, above this line, it is called borrowing portfolio. Below this line, it is called lending portfolio. Borrowing portfolio means that above this point, if you made the investment, you borrow at the risk-free rate of return and invest in the risky securities. Here, this point, you say that a portion of investment is made in the risky securities as well as risk-free securities. Here, at this point, there will be no risk, and risk-free security investment will be this. So here the capital market theory explain this line. This is called capital market line. It is called your capital market. And here, very important, the risk is always shown by the this. So this capital market theory says that that will let you know how much. This is also called a market portfolio. Okay, this as per this theory, it says that how much you can say that how much will be your return at a particular level of risk if you are lying here and if you are lying here. So that will let you know. Now, student, one important point, there is a concept of security market line, SML. Now, security market line is a graphical presentation of CAPM. Okay, while we have covered here the SAPM, your this standard deviation, here in SML, here we cover the beta. Because see, in earlier diagram, here this risk is consistent of both. That is your systematic as well as your unsystematic risk. Here it will cover only systematic risk. So if your beta is 1, this is called your market return. Your return will be RM. Here this RF. Now say if your beta is more than market, your CMN will be here. If the beta is less than market, your return will be here. So this is called SML, security market line. Okay, now there are that this topic has been covered. There is another topic that has been covered in the fixed income portfolio. Okay, how much you have to divide your income in the portfolio. And even there is also topic covered. Normally, theoretical question has been asked from this. Of course, small practical can be formed. There is one topic is portfolio. You can say portfolio strategies. Like there are 3 strategies have been covered, like constant ratio, constant rupee plan. So all these topics have been covered. Okay, students. Now I am coming to the next. In case you have any query, just ask, because there are a lot of things to discuss, but I am covering some important topic. In case you have any query, just let me know, like the other students are sending their queries. Now there is another topic is securitization. Chirag, just read out the topics.
The first topic in securitization is introduction. The second topic is concept and definition. The third topic is benefits of securitization. The fourth one is participants in securitization. The fifth one is mechanism of securitization. The sixth is problems in securitization. The seventh is securitization instruments. The eighth is pricing of securitization instruments. And the last is securitization in India.
Okay. Now, student, this is a purely almost you can say the theoretical topic. Normally, no numerical question have been asked till time. And because here the securitization, what is securitization? It is, you can say that it is a vehicle that converts illiquid assets into liquid assets. Normally, what happens in the balance sheet of every company, normally, because they sell the goods on credit or services, the debtors or receivables are lying there. Now, these, of course, this is an asset of the company, but they are not cannot be used by the company. So what they do, they transfer this company, this all receivable to any vehicle that is called special purpose vehicle. And this vehicle, what does it does? They issue the securities. They bundle all the this instruments, all the receivables, and they issue the securities to the investors. Whatever the money comes to the SPV, that is transferred to the company. Okay, so this topic has been covered in this topic of securitization. Now, if we talk about securitization in India, it has I think it has somewhere come around in India in 1990s, where I think Citibank was the first bank who have converted their home auto loans into this small securities, and that has been acquired by the financial institutions, because normally these securities are acquired by the financial institutions or the banks, because for the bank there are some requirements, statutory requirements, that you have to invest this much of your money in particular category. So normally these instruments qualify for this category. Now another topic is mutual fund. Now student, here this topic is theoretical as well as numerical. In the mutual fund, normally we cover small how we calculate the uh, return on the security, and NAV concepts there are there, tracking error is there, one or two concepts are there. Now students, sometimes if questions come into the mind, sir, why this is topic is important from strategic aspect. Now student, if you notice that there are some questions where a company has invested a huge amount in any mutual fund, surplus there, so or they have a funds they have invested in different. So here two aspects come into the picture. One is investment from the aspect of a company, and mutual funds calculate NAV calculation of the mutual fund. That is the more important, and this has been covered. That if any mutual fund is having say fund of 10 lakhs, and if the have been invested in their different securities. Now, if the say there are two securities they have invested in 5 lakh in each. Now, suppose with the market change, the value of the security comes. I just giving an example. Say there are 10,000 units. So here NAV will be 100 rupee. Okay. Now say 5 lakh here this, and here this value increase to 7 lakh. Here this value decrease to 4 lakh. So new value will be our 11 lakh 50,000. So divided by 10,000, the value comes our 115. So this is the NAV after a certain period. Of course, there are some questions like that if they are declaring some schemes are there, because there are two type of, one is bonus scheme, another is dividend. They are declaring dividend scheme. In a generally bonus scheme, what happens, there can be a reinvestment, not in a, it can be both way. Whatever they are bonus scheme, they issue the new units, but in the dividend they normally issue the dividend. But in the dividend there is one aspect that is called reinvestment aspect. Sometimes the units are reinvested. Okay, of course, then there will be a because if their dividend is consumed by the investor, so there will the fund will be decrease of the company. So of course the NAV may not be that much impacted, but when it is reinvested, there will be an increase in the NAV of the company. Okay, student. So these are all things have been covered in this topic. Now just read out the topic. May I just then I will throw the light on the same.
Yes, sir. The first topic in derivatives analysis and valuation is forward or future contract. The second topic is options. The third topic is swaps. And the last one is commodity derivatives.
Okay, student, this is one of the very important and favorite topic of the students. But as in my every class, I give one disclaimer. You can say it is kind of a rider. Dear student, please note this topic here is purely for the academic purpose only. So don't indulge yourself in any speculative activity, because normally derivative makes you it gives you a very insight that, oh, I can make that money. But my advice to you, please don't indulge. Even for the learning, you not to indulge yourself in this kind of practice, because here we are giving very basic theories. Okay, the exact modus operandi can be vary from country to country and even exchange to exchange. So here we are just giving the very basic idea. Now here our purpose of giving the idea of derivative not for the speculation purpose. Of course, they have been, but here your main purpose here is the hedging purpose. The making you about the concept of is you hedging. Hedging means management of the risk. How we can use the derivatives in the hedging our positions. This position can be in a foreign exchange. This position can be in the current bank securities. This can be in the market. Okay, so that is a more important. Now, when I talk about the forward contract, I'm just see student here. I'm just giving very basic things. In case if you have any particular query regarding any question, so then I can also discuss it. But here I'm just giving very brief overview. Of course, I will cover how to crack the exam, that I will cover, but not very here. I will say just very quickly cover here. Now, forward is kind of a, you can say that, and I can say that if I say that what do you mean by the term contract? Contract that you have read at your intermediate level. One second, I just. Now, when we talk about the term contract, here means agreement plus enforceability by law. This is a basic definition that you have studied at your Indian Contract Act. That becomes contract. Okay. Now, when I talk about the forward contract, it becomes contract plus execution at some future point of time. True. Now, when I talk about the future, it comes forward contract plus exchange mechanism. Because forward contract is a kind of a OTC contract, over the counter, between, say, I am Chirag and I am entering into a contract. This is kind of a forward contract. Simple. Okay. Okay, Mank. See, Mank is asking, please suggest the important topic or the areas of the theoretical question for mid. Student, please note that I cannot give you a precise list. This is a topic important. Every topic is important. And it is a beauty of this CA examination that all topics are important. Because I am chartered accountant, Chirag is also chartered. Chirag, what is your experience?
My experience was same as sir you're saying exactly. The question can be asked from anywhere, so all the students have to prepare all the theoretical topics as well as the practical topics. Do not leave any topic untouched.
Students, I am the same. I have way back. It is almost 27 years back. I have cleared my CA, but I think Chirag, you must not even 27 months have been passed after you have passed the
Yes,
CA.
sir.
So even a young my young colleague is also advocating that nothing, no topic can be said important. All topics are important. Of course, from the past suggested answer, you can see or judge the pattern of the questions. What type of questions can be asked? Okay, that can be helpful. But you cannot say that because it is a paper setter's freedom. It is a paper set. I cannot enter. We cannot enter into the domain. They have their own way of testing the knowledge, and this is the beauty of the C examination. Any question can be asked because if this type of a pattern will be there, so of course the question paper are a balanced one. It does not mean that all the question will be asked from the derivative. The question will be balanced paper. Question paper will be balanced. Okay, so don't worry about the same. You just see and prepare all the topics equally important. Sorry, students. Now then other is for future contract plus an exchange mechanism. Say I Chirag or I am entering into the contract, forward contract. It is OTC contract, over the counter. But now if I punch my order and for the buying, and he punches his order for selling, and our there is an exchange mechanism in between us. Of course, we are buyer and a seller sitting together, but there is one exchange mechanism that is called future contract. Okay, student. Now next is your option. It can be forward or future Okay, it is backed by choice or right, not an obligation. Choice or a right, not an obligation. Here, if it is backed by or it is added by one point is called option contract. Okay. Okay, students. So these three things have been covered here, and another is swap. Now, swap means interchange. Of course, swap is more important in case of a interest rate risk management, and where I will discuss there are two parties. Okay, here this can be happen that there are two parties. One may have a strong position, another may have a weak position. Still, they can buy, they can interchange their loan. They can do the like that. They borrow one at fixed rate, another is borrow at floating rate, and interchange it. That the process has been explained in the study material. Even questions have been asked. Okay, so here you can say that now all the we can say that float. So all has been covered, but this is normally covered in case of a foreign interest rate risk management. That has been covered. Now next question comes. Topic comes is the commodity derivative. Now commodity derivative means like see when we talk about the derivative. One important aspect is underlying, because derivative there for every derivative there is some underlying. Okay, now in this topic normally the cover are stocks, that is shares, and then it is covered index. Okay, now next is it can be your foreign exchange, and last is your commodity. And one is more thing, I am just my here, one is interest rate. Even you can put commodity, interest rate is also. So normally these five that underlying are covered in our study in our syllabus. Here this will be covered in our chapter on forex, this will be covered in the interest rate risk management, this is normally covered here. And normally these index derivatives or index futures are covered to hedge or you can say risk adjustment of our portfolio position. Because in one you may find that in one question you may be see that it is asking that if the company wants to increase their beta, the company wants to decrease their beta, so all these are covered using the index. Now here student, please, I just want to link this topic if this matter has come here. When we talk about the portfolio management, in a portfolio management, when we talk about portfolio management, if we want to adjust our systematic risk, that is beta, so it can be done either two way, by buying or selling. Not selling, we you can buy buying of risk free securities, or by borrowing money and investing in risky securities. So another is method is using the index future. By this we can adjust the beta. So that topic has been covered here in our this topic derivative. So these two topics are to some extent are linked. Okay, students. Now here, so commodity derivative, I am just discussing commodity derivative. So in commodity derivative, when one or two important aspect like hedge ratio. Okay, that how much, whatever should be the our short position in the market, so that our commodity we can hedge our position in the commodities, because commodities are important basis of the every market. Although it is its market has that not much been developed in India, but worldwide the market is very much developed. Okay. Now next topic comes foreign exchange foreign exchange exposure and risk management. Okay, just read out the same, then I discuss the same.
Yes. The first topic in this chapter is exchange rate determination. The second topic is foreign currency market. The third topic is management of transaction, translation, and economic exposures. The fourth topic is hedging currency risk. The fifth topic is foreign exchange derivatives, forward, futures, options, and swaps.
Thank you, Chirag. Now, first, because this topic is also very important topic. Now you will say, sir, you are saying that every topic is important. Why? But why you are saying it is very important? Student is important, of course, from the examination point of view, but is also important from your general understanding, and even for your when you will come into the practice after that, or in your job. This will be topic will also important, equally important there. Now, student, I'm just discussing with you because I'm why this topic as I'm just taking back you to some history. Before, what happens somewhere around 1990, before 1991, the topic was important, but that much was not. This topic was not that much important. Why? Because before some around 1993, before 1993, there was some kind of a managed floating system. Managed means somewhere the dollar's price vis-a-vis to the rupee was that not that used to be does not move to be that much. Okay, and system was that there was used to be only single rate at which the buying and selling, because there was, because economy, Indian economy was that much not globalized. Whatever with the Indian using the forex, that was using forex for the petrol. But post 1991, post liberalization, with the opening of the market India, both from import and export point of view, the foreign exchange market has gained a lot of importance. And it is in 1993 that dual rate system, that is, you every bank has to give the two rates. One is buying rate, another is selling rate. So it is just has become a kind of a commodity. So that after that, the foreign exchange exposure and risk management has become an important aspect. So all this topic has been covered in this topic, and it's a very interesting topic. So first of all, it comes with the your topic. Okay, Narayanan, please explain how to remember Black School's model. Hmm, yeah. Okay, Narayan, just note it down if possible. Then I will. Yes. This possible because I have to bring my slide. Let me check. Okay, Narayanan, if possible, will be there. Otherwise, you just send me a mail. I will just share my email ID. Just then you, or you contact me over the telephone. Then I will let you know. Okay, if possible now, I will cover it because it will take some more time. Because it this formula can also be easily remembered. Don't worry, I will give you one logic. But here I think because I have to look out for some my notes. Now, before after that 1993, the market has become, say, foreign exchange has become gained a lot of importance, and its exposure management has become important. Now all these topics have been covered. So first, rate of how we determine the rate of a currency. Now for the determination of the rate of currency, there are main two theories. One is purchasing power parity, another is interest rate parity. Now, student, I just give you a very small example. Of course, there are some calculations are there, but purchasing power parity and but I'm just giving you a small hint. Say if I say that 1 kg of apple of particular quality, say somewhere it is quoted at $2 per kg in USA. Okay, same quality of apple in India is costing rupees 150. Okay. So now, as per this theory, this says the parity means equality. The rate of per US dollar, although it is a very based on very simplistic assumption, because there are two forms purchasing power. I will discuss. One is your absolute form, another is relative form. Okay, I'm just discussing very simple plain form, absolute form. Now it says that 150 divided by means rupees 250 is equal to this. So the rate will be justified rate will be 75. Okay, student. Now what happens? Say in say USA the inflation. I'm just please assume that I'm not saying that in USA the inflation rate is say 5%, and India it is the inflation is 10%. Okay, after 1 year, the same apple will be cost $2.10 in US and 165 rupees in India. Okay, now question arises, how much rate will be justified? So we now the new rate will be thanks. Okay, 78.57. Okay, this will be rate about 78.57. Now this rate can also be find out by using the formula. How we can find out this formula? Say our current rate is 75 into inflation in India. Okay, student. Now let us find this value. The value will be same. 78.57. So that's why the logic of this theory is that the logic of this theory is that so but this since it is a very simple theory, there is another version is used that is called a relative form, wherein it is said that we cannot say apple of a same quality will be there, rather we use a basket of goods, compare the basket of goods prices in India as well as vis-a-vis to the prices in USA. From there we can compute. So this is the basic. Now I am coming to next, interest rate parity. Like we have discussed here the here we have discussed the inflation impact. Now this can also be considered as interest impact. Now when we talk about the interest, there is one concept is nominal interest rate. Nominal interest rate means is equal to 1 plus real rate into 1 plus inflation rate. 1 plus nominal rate that is come. Okay, so we can calculate the nominal interest rate, and this on the this nominal interest rate we can calculate the prices of the foreign exchange. So how this says this according to the series says that suppose I invest $1 in US, correspondingly today's rate is 75. Now here suppose the rate of interest is 2%, here the rate of interest is 8%. Okay, now what happens after 1 year? The rate will be 1.0. My investment will be $1.2, $1.02, and here my investment value will be 75 into 1.08 will be 81 rupees. Okay, so the justified rate will be okay, student. So here we can also find the value like this: 75 into 1 plus rate of interest here is our 8%. The same value we will get. Okay, 79 points. So this is the logic of the interest rate parity. But here, students, please see that if there is any deviation, because the logic of this is that if there is any deviation, then there will be an arbitrage opportunity, and that is called interest rate arbitrage. You have the topic of has been covered where the topic of has been covered uncovered and covered interest arbitrage. In covered interest arbitrage, what does he? He takes up borrow the money in one country, invest in another country. Okay, although assumptions are there that there are no taxes, etc., but he is borrowing in one country and another investing in another country. So by this they can make the money if following this arbitrage. Covered means they are already taken the sell or buying position in a foreign currency after a certain period of time, and they if they let it remains open, that is called uncovered. And then it comes the foreign exchange market. Yeah, you know, next topic, foreign exchange syllabus test. Foreign currency market. Okay. Foreign currency market, but one of very important feature is here. This is 24 into 7 market. That is one of the more important feature. The reason is that when the market of one country remain closed or closes, the market of another country opens. Okay, and the main part is hedgers, importer, exporters, banks, even government. Recently, if you are going to the okay, if you are referring the newspaper, then you will see that there are news that RBI has purchased the dollar. So you can see that to stabilize the rate of interest, even government is trading in the market. Okay, so that's why if you want to create the interest in this topic, it is always better that you refer the financial newspaper on a daily basis, one financial newspaper on a daily basis, because you will also know the nitty-gritties of the foreign exchange from this topic. One second, abhi, one एक दो topic और है, that's management. I will take care of the same. No problem. I have solved it. Now next is our management of the translation, transaction, translation, and economic exposure. Now question rises, what are these kind of a risks are there? See here, suppose I'm just giving you an example of exporter. This can also be used for the importer. Now exporter has billed its client, say $1 lakh. Okay, the money is today's rate is rupees 75. Say, assume that. Okay, now he says ki of course my revenue after 75 3 months I will earn rupees 75 lakh because of conversion. Now suppose by the time money comes, the rupee has become stronger and this rate becomes 74. So of course at the time of conversion, the money will be 74. So here this is 1 lakh exposure loss will be risk. It can both way. If the rupee has become weaker, so the gain will be 1 lakh. So exposure means it can be both way, positive and negative. So here the this exposure is due to the transaction. That's why it is called transaction exposure. Next is translation. Now just I give you continuing the same example. Continuing the same example. Suppose this billing has been carried out on 29th March. Of course, the remittance has to come around say in the June, somewhere in the June, the money has to come. Now what happens? They have to book this amount in their books. Okay. Now when they will show this amount in the books, because since the reporting currency of the Indian company is the rupee, so they will convert at the say on 31st March, the rate was same 75. So they will say receivable as a 75. Okay, now suppose after 1 month they have to again prepare the balance sheet. Now at this time the rate has become 74. So the amount will come 74 lakh. Of course, you will find that there is a decrease in the assets of the company by the 1 lakh. So this exposure is called the translation exposure. Normally, this is not coming usually picture out in the case of a receivable because the amount is not that much, but this normally rises in case of a long-term assets like shares, debentures, investment in the companies because they are normally continuously held for the long period of time, 3 to 4 years. So in the 1 year's balance sheet, say if you are holding the share of a one company in a $1 lakh. So one time the rate was 65, the 65 lakh was there, but now today the rate is 75 lakh, 75. So rate same dollars, same company, same shares, but the value is 75 lakh. So there is a gain of. So this is called, normally this does not affect the fund flow of the cash of the company, but this normally affect the cash flow of the company. Now next is economic exposure. You can say it is not a direct kind of exposure. While this two exposure are direct, it is kind of an indirect exposure. Normally what happens, this impact due to the currency demand, change in the demand of any product of your country's product due to change in the interest foreign exchange rate. So say if the rupee has become weaker, of course the sale, say if the rupee has become cheaper, then of course the product will become, Indian product will become cheaper in the international market, and of course every company will buy. And that is the main reason that Chinese yuan, there is a fight between US and a Chinese government that US saying you just revalue your Chinese yuan because yuan is very strong currency, but government of China is not revaluing it because if they will revalue it, the yuan will become stronger and ultimately the demand for the Chinese goods will be come down. So to maintain the goods, the supply, their goods demand, the Chinese yuan country is not revaluing their dollar, their Chinese yuan. So this is due to the economic exposure. Next is hedging currency risk. Now how we hedge the currency risk. So normally, although there are some techniques, here we discuss normally two techniques. One is internal and external. In internal, there are some like netting and lagging, leading and lagging, and there are one or two techniques are there. But in external, normally here you make your own adjustment. In external, normally these strategies are in addition to that. That is extra parties. There is one another top techniques is covered money market hedge. In this, you how you plan it. Say after 1 year, 3 months, you have to make a payment of dollar of 1 lakh. Okay, so now today you say that my dollar is say rupees 75, but your apprehension is that it can become rupee per dollar. So what you do, you go for the US market. Okay, you see that the rate of interest there is 2%. Okay, there you see that rate of interest in, whereas the borrowing rate in India is 8%. Okay, what you do, you borrow the equivalent amount that makes same, because what you will do, you borrow today, how much amount you will borrow today? 1 lakh. This much of amount you will borrow today in forex. Okay, this much of amount you will borrow today. Okay, now this much today's what is rate? But since you don't have the money, US dollar, you have to borrow it from the foreign country. But today you will borrow Indian currency. How much amount you will borrow in Indian currency? This much of amount you borrow today. Okay, at rate of interest of 8%. Now this amount you invest in USA, there this amount becomes after 3 months become 1 lakh. You directly pay to the party. Okay, and what happens? You whatever amount you have borrowed, that is 7,462 650, you repay this amount with the interest in India. So the amount comes 76 lakh 11,903. So ultimately you see that your outflow is 76. So according by this, the effective rate you are paying per dollar is 76.12, because your apprehension was that the dollar may not come 70. So by this, ultimately you have freeze your rate at 76.12. Okay, and there are other techniques forward, future options have been covered there. Now I am coming to next topic. Now student, this topic is basically combination of your two topics, because you have discussed the topic of, as I discussed with you, financial management at your intern level. Okay, here there is international flavor has been added, and this has been added. So we can say that forex plus financial management become the international. Now here, whatever we have covered, discussed in the financial management, that shall be covered here. Views from the aspect of a foreign exchange. How foreign exchange international capital busting means? We are investing outside the boundaries of India, because simple capital busting is basically a domestic. International means outside the boundaries. International working capital management, multinational cash management, and receivable management. So all this has been covered here. Normally, multinational cash management numerical can be asked. Still now, multinational receivable management, I think never question has been asked. But international capital busting is important from the numerical point of view, because normally questions are asked in this. Now another topic is the interest rate risk management. Can you read it now?
Yes, sir. First topic in interest rate risk management is interest rate risk. The second topic is hedging interest rate risk. It has two parts. The first part is traditional methods, and the second part is modern methods, including interest rate derivatives.
Okay, student. Now, when we talk about the interest rate risk, as we have covered our, this is our, you can say, last category of the financial risk that is covered here. We have covered stock portfolio management, that is market risk. Then we have covered our currency risk, foreign exchange risk exposure and management, and how we manage by using the derivative. Now, here in the last, we are covering interest rate risk. Now, in the interest rate risk, this is the rate risk associated, as I told you, that even we are investing in the fixed income securities, the we are carrying the risk. And a very good prime example that normally covers is a recent crisis is SVB bank crisis. Silicon Valley Bank crisis is related to interest rate risk. It is a prime example. Why it is prime example? Because what happened? They were having they are having the money, Silicon Valley Bank, because they have them. Some of the startups, many startups have invested their money with this bank. Now, somewhere around 4 to 5 years back, when the rate of interest was somewhere around, I think, 1% or even lesser than it, they have invested a huge amount in treasury of the treasury bonds of the USA. Now, for the last 1.5 year, the Federal Reserve, that is like RBI in the US, Federal Reserve is there, that decides the rate of interest. So they are increasing to combat the inflation. They are increasing the rate of interest, and as a result, what happens? Somewhere maybe today's rate may be interest somewhere around 3%. So what happened due to this increase of 200 basis points? The value of securities they are holding at 1% has drastically fallen down. Okay, so when one or two investor has requested for the money, because in banks normal money they does not keep the money, they keep their money invested. When they go on to the market and start selling it, so what they found that they are selling at a very huge discounted value. The bonds were selling at a discounted value, and ultimately what happened when this news spread, every investor ran to bank, this is called bank run, to get their money. So what happened ultimately? The bank collapsed because they could not meet the expectations of the depositors. So that's the prime example of today's current example of interest rate risk. Now there are traditional methods like ALM, etc., gap analysis, that normally used by the bank. But for the corporates, normally the methods are include interest rate derivatives. It also covers your forward rate agreement. I can just parity give a forward rate agreement is kind of a forward in forward derivative that we are covered in. Okay, now then IRF interest rate futures, that is futures in stocks, oblique index. So here underlying is stock and index. Here the underlying is interest. Then interest rate option, or also called guarantee. Okay, so options. So here again, this is the same, and here the underlying is. So this is a, and there are some strategies have been discussed like collar, cap, and collar have been covered here, that are normally used with the interest rate option. And one important that I have discussed with you, swap strategy has been covered in greater detail, and that has been even numerical questions have been asked within some last few exams. Almost no interest rate hedging. Mayank, I could not get your point. They had almost no interest rate risk hedging. Yeah, okay. You are talking about the Silicon Valley Bank. Very, very good. Because they have not adopted any strategy and that's why they have lost. Very good. Bank, very good. Your analytical power is appreciable. Okay, students. So this has been covered here in this topic. Now, next we are covering corporate valuation. Here, the method of valuation has been covered, and in this category, we have covered EVA, MVA, SVA. All these has been covered, and basically methods have been covered like net asset base method and multiplier method, chop shop method. So all these have been covered. Now here in this topic, if we compare with the security valuation, of course, in some places you will find that for corporate valuation, even security valuation can be used, because if a company is having say 1 lakh share, okay, the value of one share is say 100. So the value of company can be simply said that it can be 1 crore. Okay, now next is our, let's read it out quickly so that it's
The first topic in mergers, acquisitions, and corporate restructuring is conceptual framework. The second topic is rationale. The third topic is forms. The fourth one is mergers and acquisitions. The fifth one is divestitures. The sixth one is ownership restructuring. The seventh and the last one is cross-border mergers.
now here when I in the beginning I have told you that merger acquisitions, we discuss the financial aspects, This can be valuation, relating to valuation, that we have covered in earlier chapter. Then there can be a swap ratio, exchange, how much, because once the valuation of securities is clear, then we can decide how, in what proportion will be changed. Diversity use is also important because demerger is, because nowadays what happen, of course, there is a spirit of the merger acquisition, but demerger also is very important because sometimes to concentrate on one business, a company may sell off their one another business. Okay, recently I think there was one example, maybe somewhere around in May 2022 or somewhere I have given in one class. There are somewhere about Summi Motherson. Demerger news was there because they want to concentrate on their one business. So this kind of a news was also there. Then there is ownership. It is called internal reconstruction. That normally covered in your financial, may covered your financial reporting paper. Cross-border merger, normally numerical theoretical questions are asked when you cross the borders. It involves one aspect, and that is aspect of foreign exchange risk. Additional thing. Okay, so okay, now we are coming to the last topic.
The first topic in startup finance is introduction, including pitch presentation. The second topic is sources of funding. And the last topic is Startup India Initiative.
It is student very small theoretical topic because startup has nowadays very hot topic. Days are gone because if I talk you, days are gone. Of course, we are studying still the top cost of capital, etc. But now the time has changed a lot. The business model has been completely changed. Earlier, there used to be say very long process of forming a business. Like if I recall that, and even today you maybe read that there is one sole proprietor. Okay, okay, there is one sole proprietor. Then he becomes, if the his business grows, he takes a partnership, joins a partnership. Now it is called LLC also. Okay, LLP. Sorry, LLP is called. And next is your partnership. Then it becomes private limited company. If the business more grows, then it becomes a public company. So you see that there is a quite a long time, long gestation period. Once a business starts with some and it reaching to this. Even the good, very today's empire, business empires have taken a say period of long period for building this empire. Okay, but now the business model have quietly changed. In today's world, the startup finance, you can say the funding requirement is somewhere around here. It is a parity, like even the companies are sponsoring or they are not okay, not if a public limited company. I can give a parity with the private limited company. So now if you start up with any idea, and if the idea is appealing to the funders or the this is your funding venture capitalist, they will fund they will fund like nothing. Okay, so now today's the model has been changed, and accordingly the startup finance has gained the importance. So here we have small topic how the startups generate the funds from the different sources. They can either from be bootstrapping, they are either can be from the family members, or there can be any and how they have to make the presentation. So all this has been covered, and even small glimpse have been given about the Startup India initiative. Of course, this can be changed time to time, but normally we have kept it just you can refer it from the study material. Okay, student. With this, we come to the our discussion on the syllabus. Now, quickly, I am discussing what was point was it?
The first was how many decimal
Well,
points in
there is one common question among the students, sir. How many decimal points we should round up the answer? Now, student, here one very important point. Follow the instruction given in the question strictly. If any instruction have been given that you have to round off up to 2 decimal point, then you have to follow the same instruction, irrespective of anything. Okay, if you increase or decrease the decimal point, you will lose the marks unnecessarily, because in this matter, their examiners are very strict. Okay. Now here in foreign exchange, forex question, the question is up to dozen. Follow the pattern of quotation or rates given. Okay, now suppose what happened? Suppose in the question on the forex, the rupee rate has been given like that. So this is a clear-cut indicator that you have to round off your rates at the 0.50, 2 decimal point only. Now suppose same rate has been quoted like this. So this is a clear-cut indicator that it is you have to follow this rate. Okay, now if it has been given like that, which is normally rarely given, you have to follow this 3 decimal point. Here what happens when we talk about this point, if you see that there are normally the multiple of 0.025 is there. This is normally followed in FIDI guidelines. Okay, and as per FIDI guidelines, the rounding off shall be has to be made in the multiple of 0.00225 rupees. That is okay. So this is a clear indicator that you have to round it off this like that. This is another clear indicator. Of course, normally if it has been mentioned that you follow the FIDI guidelines, then compulsory you have to round it off in this in the multiple of this 0.225. Okay, so this is another case. Now space if you are following the question of the security valuation. So here 2 decimal points are okay if nothing has been mentioned. But for accuracy, like if this value is using in for any valuation of a company, then of course 3 decimal point can be considered also. Generally for a valuation of a company, 3 decimal point of a security price are taken. Now when we another very important aspect, when we talk about any valuation and figures are in crores say, then here my advice to you, at least follow up to 4 decimal point if nothing has been mentioned. Because what happened, even 0.00, this digit will matter a lot in your decision. So or it can you can do it 3 also, but 2 will be quite very you can say it will be make your decision indecisive. So my advice to you, in that case you can follow. So there is no hard and fast, even rounding of instructions are ignored, rounding of error are normally good if nothing has been mentioned. But if instruction has been given, then that has to be followed religiously. Okay, now another question has come, sir, how to excel in the examination. Now first of all, sir, students, refer study material of ICI. Refer all publications related to subject like RTP, suggested answers, etc. from ICI website, or hard copy, whatever the form you like. Next, mock test. That is the most important. Mank has asked, suppose in question PVF not specially mentioned. Oh, thank you, Mank. You have remembered me. If present value factor table has been given in the question, I forgot one point. 3 points, 3 decimal points. There will be no harm. But for the value of debentures, etc., I think it will be better if you follow 2 decimal points. But it will you won't lose marks on that account. Okay, because ultimately the impact will be rounded off. Okay, student. Because for calculation of duration, normally we follow the decimal points. Now it is very important, students, attempt most mock test paper in examination condition, because what happens, I have observed that student normally see, you can refer this old mock test paper from the website. There is no problem. But this, I am not intentionally, I have not mentioned this here, suggested answer along the suggested answer, because when you mock test papers are there, so it is always advisable you don't refer the current mock test paper before just now, because I have observed the student normally see if any new question has been come, because mock test paper means you there is a if you are not feeling well you can leave, no problem. Yeah, for the current mock test paper, it is important that there is a surprise element. There is a surprise element, and that please don't lose this surprise element, because that will help you to uh, make you how you can attempt the exam. Okay, so this is very important. Make you see just whatever whenever any mock test is coming out, you just take a printout. If you could not attempt on the same day, just take a, otherwise there are branches are also conducting, nearby branches are conducting. I will say that you should go there and attempt the mock test and examination. Otherwise, if it is not possible, then just you take a printout and don't see it, and if possible not on the same day, another day, you just attempt in examination like condition and judge your performance from the answer. That will help you to maintain your speed in the examination. That is very important. And more important thing is recipe for success in examination. I normally covers, since it is a time of almost March, so just start winding up of your syllabus. Okay, because now it is going to be the end of the March and there is only 1 month is there. So my advice to you, at least you start winding up your syllabus and devote 5 to 7 days for each topic. Just revise it. Okay, and because one day before examination you have to, one day before examination, one day before examination you have to see that, just go through quickly the topics easily, and don't try, very important, don't try any new question one day before examination, because if the answer will be wrong then you will unnecessarily lose the confidence. My advice to you, don't discuss too much with your peers. Okay, don't discuss with too much your peers, because any confusion can uh, hamper your performance in the examination. Okay, and when you go for examination, take calculator, that is very important. ठीक है ना, have proper sleep, don't go empty stomach because of stress. Normally student does not have so all these precaution evidence, and stay confident. See student, what happens, it has been seen that whenever you come to the exam, if suppose the examination you find that all the questions, no, some questions are that you have solved earlier, of course that will boost your confidence. But if the questions are new, don't lose confidence, because the question paper is same for everyone. Question paper is same for everyone. This does not mean that you lose the confidence. Oh, इतना मुश्किल paper आ गया, how can I solve? No, nothing. But stay there, because even I have observed that students have a tendency to leave the examination hall. My request to you, please don't leave the examination hall early, even not before 3 hours, you not to leave. Just read the questions again and again. It may be possible that you may find the answers, although it may be new question paper. Okay. And if there is anything in the question paper that is out of syllabus, you not to worry about the same. Okay, so don't lose the confidence by all these factors. Stay confident there, just attempt it. And one more important that I have seen that normally found in the missing, and normally examiners complain that fresh question should be start from the fresh page. One second, I just take it out. Then fresh question should be started from the fresh page. Another very important point, uh, carry out rough calculations in the end of answer book and cross it in the end. Okay, and on the top write it rough work. And one more important point here, answer theoretical questions legibly, and if possible leave one line difference between points for readability. So these are some tips that will help you to examination. And calculation is very important, that you should check the calculation thoroughly, because even a one step if you are wrong, then all the steps will be gone wrong. So that is more important. And marks where is I'm just reading your query, but in case of the point of we never get interest expense for evaluative, if we have to short term for interest business. See, Mayank, your query is right, but normally for interest, see, if this is interest, short term debt or loan is the integral part of the business, that they are the, suppose if, because see what happens, why now you understand the logic. The if why we don't deduct the EB item interest expense because by valuing the business, because the pattern of financing can be different from company to company. So it is a choice of the company, that or the compulsion of the company for which pattern they are going. Now, if the short-term loans or a very, you can say, short-term payment, if the interest on them is a part and parcel of their business, then of course they will form the they have to be deducted. This is understood, because they will be in the inherent in every type of every in every business, same type of business, every company they will have it. But here, if we EBT in EBIT, if they are taking any loan or not, then it is there. Okay, students. So with this, we come to the end of the session, and here, student, I am sharing with you our email ID, and there is one query of this student, that was Narayana, that how can we remember the formula of this black schools. Dear student, please note that ultimately, if I'm just give me the study material. You can sit here now. Just two seconds, beta. I'll just show you how is the logic. I'm just quickly You can contact me over the telephone. Okay. I'm just giving you the logic 1 second because the student are now students see here the formula has been given like that option. Student, please note that it is, you can say it is kind of a delta something. Okay, that much of security I have to invest today. Okay, this all this security, this I have to invest today, and this much of expected return, because X means exercise price after some time. This is the present value factor. Today's the value, present value of this much, and this is the one factor additional is applied to the same. In case of a binomial model, if you recall that normally there is a delta into stock price minus present value of exercise price. This is a formula used in case of a binomial model. So same logic is applied here. Okay, student. So I hope, otherwise you can just contact me over the telephone, then I will let you know. Okay, students, with this, we come to the end of the session. We hope that today's session must be fruitful for your examination, and we wish you best of luck for your examination and come out with the flying colors. We at a board of studies now, CH Chirag Uppal is also working in board of studies with me and is taking up the queries of the student, and he will also can reply the same. Okay, student, thanks a lot. Best of luck for the examination. Chirag, you want to just
Best of luck for the examination to all the students, and thank you. And I hope you can join the same CE fraternity as soon as possible. Thank
okay,
you.
Chirag, do you want to share your any experience from your, as you are young, so you must have some unique experience. If you want to, just any advice you want to share with the student.
The advice I would want to give is refer the study material. Even if you're taking tuitions or any coaching classes from anywhere, just stick to the basis. That's the study material. Study material should be your basis for studies, and everything else will come along the way very easily. Thank you.
Now this advice is of the record because he is referring the coaching centers. Okay, anyway, thanks a lot, Chirag, for your advice. Okay, students, all the best to you, and come out with a flying colors once your result comes. Thank you. Thanks. Have a nice day.
Thank you.